we are facing a very interesting issue. So business is scrambling, productivity increasing, pricing power increasing. What this is telling us is profits are screaming. And last year, I remember talking about a V-shaped recovery where by the end of 2021, perhaps we would see an annualized rate of S&P earnings at the $200 range. It looks like we've passed it already, and that we could be at 250, 260 moving into 2022. And with the S&P at roughly 4,200, that means we're looking at a multiple of 16 to 17 times, which given interest rates in the 1.5% range, which is where we are in the 10-year Treasury yield, that is a very modest multiple. So now onto the market. I know that late last year and into early this year, we had been saying that we believed the market would rotate and start to reward more sectors, more value sectors that had been neglected. That it has done, most assuredly. In fact, perhaps more so than I might have expected. And at the time we said, look, innovation-based strategies will underperform during that kind of market. And of course, that too has happened. We're fascinated to see that the two top performers this year are energy, up 40% year to date, if you can believe that, and financials up 27% year to date. And if you look at innovation type strategies, the kind of hit they've taken here, from the peak in the middle of February, many are down 30 to 35%, which is quite a hit. Now, as I said earlier, I think exacerbating that hit has been the threat of a near doubling in the capital gains tax rate. So innovation-oriented strategies would be hit hardest by that. I also mentioned in the last call, I believe, that we have been very reassured that the equity markets have gotten through three mini crises in the last 4 months. One was in the first quarter, interest rates, long-term Treasury yields, nearly doubled from 90 to 175 basis points. That is the equivalent of a heart attack in the bond market. And normally the bond market impacts the stock market. Whenever there's anything very sudden happening in a very important economic gauge out there, the equity markets responded. Well, the equity markets took the yield increase as a sign that the cycle was beginning to grab hold and gain even more momentum. And that is true. It has done that. As I explained last time, however, we were struck that that a capital ratio, which the Fed, a bank capital ratio, which during the depths of the coronavirus, the Fed made more lenient, enabling banks to buy long-term bonds instead of just bills to satisfy the capital ratios. That ended at the end of March. And interest rates having shot up that quickly, many people thinking because of the cycle, most assumed that they would continue to move up. Well, they have not. And it is very interesting, again, the highly valued stocks, those associated with innovation, the interest rate move did hit them hard, or finally it hit them hard during the first month and a half of this year. They seemed impervious to almost anything. Well, now interest rates have settled down against expectations. I think even today the consensus expectation is long-term interest rates will continue to move up, and they may. But it is interesting that the ending of that leniency on the part of the Fed vis-a-vis the capital ratios coincided with interest rates topping out. I think most portfolio managers, analysts, strategists would be very surprised if interest rates were topping out now. Cyclically. And I can't even tell you if they are. I'm just struck that we've had a lot of these booming indicators, commodity prices. You've got copper prices breaking out of, let's see, I think this is a 15 to 20 year base that went from, I think it was from 200 to 465. That's the copper price. It has now moved out to 475. And most traders would tell you when any price has spent 15 to 20 years in a base and then resolves to one side, it's usually the beginning of a very big move. Now, it could be. We're watching this very, very carefully, but it is curious in the face of that long-term treasury yields have moved back down. And at the same time, the dollar has come down, which is feeding commodity prices. And yet, once again, the long-term treasury bond is not responding to it. So I find that very interesting.